For all verified facts, subscribe to our YouTube channel and click the bell icon to get the latest updates.
Hello and welcome to From the Front Lines. I'm Govindraj Ethiraj. So first, it was an expectation of a likely Trump win, which kept the market strong and steady. Then it was indifference. The market said that we don't care whether it's Biden or Trump. And now it's Biden. And the markets continue to soar, not just in India, where we've seen almost a 3,000 point rise in a week's time, but globally, where markets are continuing to be strong. And the index here in Mumbai rose about 704 points to end at an all-time high of 42,597 after hitting about 42,645. The Nifty hit to 12,461, the Nifty 50 companies, that is. So overall, the trend is very, very bullish, which is also a little contrast to what's been happening economically, not just in India and world over. As you know, there's a pandemic going on. Economies have contracted or actually collapsed, and quite substantially. And that, as we all know now, for a while has not really made a difference to the markets, which have been roaring back up since the month of March. So the question now is, given that there are these new trends, which is a Joe Biden victory or Joe Biden president-elect position in the United States and a lot of money flowing in, why is it happening in India, and what does it really mean going forward? To discuss that, I'm joined by two well-known capital market veterans, Amisha Vora, Joint Managing Director at Prabhudas Lilladher, and Ambareesh Baliga, an independent market analyst. Thank you both for joining me. Amisha, let me start with you. So what's going on?
So I think it was very clear. Fed had made its intentions prior to elections also many times clear that this monetary policy regime which we are into, it's lasting till 22-23, and at every occasion where we need, as a global economy and particularly US economy, they are there standing and watching and ready to act. So one thing was clear, that this easy money circulation was likely to continue, and generally Fed is also supported by all the large global central banks. I think one very clearly is that impact. Second impact, of course, is emerging market, developed market to emerging market flow, which has been happening both because of the dollar weakness to some extent, because of the very large flow of money that they have created. And of course, emerging markets as a set also had suffered a lot and are supposed to bounce back from economic perspective. So both these put together, the underlying trend has remained same. The moment uncertainty got over, markets are seeing very huge flows coming in.
Okay, Ambareesh, how are you seeing it, and what's different this time?
No, this time I think the major difference, I would say in the last 7-8 months, has been the retail flow. Because people were sitting at home, nothing much to do, they had enough money in their account, and the only activity which was there in the market, which was there was the stock markets. And if you look at the numbers, there are close to about 60 lakhs as of, I would say, October, and now it may be slightly more than that, 60 lakh new investors who have come in. And what more can they ask? Because from the time they started investing, they've been making money. So this could be beginner's luck for them, but still, since they made money, there is a lot more confidence, and because of which more funds are being employed by them. And even if you assume 1 lakh rupees per person investing in the market, it works out to about 60-70,000 crores. And like I said, most of them have, in fact, invested more. So just imagine the amount of liquidity which is coming only from the retail investors. And to top it all, we have had FIs also investing. Looking at the macro numbers, they have been improving, no doubt, month on month. Look at the GST figures, that's improving. And when we're talking of the earnings, a lot of analysts were skeptical whether the earnings would really pick up so fast or not. And again, Q2 earnings also have been better than expectation. So, so far, so good. And because of which we are in fact seeing these markets rally. Now, if you ask me as to till where it will move up, it's quite difficult to say. But whatever said and done, if you look at the broader picture, I think clearly the bigger boys are becoming bigger. and the smaller and the mid-sized ones are actually suffering, which in fact we may not be able to see that in the markets, because in the markets we normally look at the bigger companies. But I think the problem is basically with the smaller guys. And if the economy has to improve overall on a sustained basis in the long term, I think everyone has to be taken together. You cannot grow only with the larger guys.
Right. So the monopolization of companies or stocks is now a very, very well entrenched trend. So let me come back to you, Amisha. Amisha, so before the pandemic, I'm talking about March, early March, we were obviously doing better as an economy, and companies were also in good shape, and the larger base of companies as well. And yet the indices were much lower than what they are today. So how does one explain that?
So, you know what, pre-pandemic, if you ask me frankly, the economy growth was slowing down anyways during 19 also. But the early signs of recovery were there in the rural economy. During pandemic, what happened is, while manufacturing got impacted, demand got distracted to a great extent, the rural economy strength increased and continued to be very good. That got added by this continuous reduction, even domestically, in interest rate. I think in terms of a new car purchase interest rate, or a new house purchase interest rate, or anything that you want to buy, the interest rates are at the lowest for over more than a decade. So I think the consumption is likely to bounce back. And the most critical part which has happened is, with this low interest rate, real estate prices having gone down for almost last 10 years, if I remember right. And during that period, the income levels which have gradually kept going up, the equation on housing front was almost very well set, and work from home culture has now given the last fillip for housing demand to come back. And typically when a housing demand comes back, the multiplier impact in the economy is too good, too huge, and too large. And I think we've just entered that phase if we see in last 2-3 months. So economically also, we are much better placed than what we were pre-COVID, both, but for the tight impact of hard impact of COVID, which happened over those 3-4 months.
Right. So housing and its multiplier. So Ambareesh mentioned, Amisha, about the 60,000-70,000 crores that potentially has come in from retail investors, who are a fresh class of retail investors. You talked about the institutional flows because of the regime of easy money. So what's your sense? I mean, how are these two forces balancing out?
So the retail flows, even globally and particularly in US, also had been very good. But my point of view here is that till some time back, we were seeing that the flows are very good and the economy is going nowhere. Now it appears that despite the moderate amount of packages which came to support during COVID, economy, from debates between W-shaped, L-shaped, U-shaped, whatever shaped recovery, seems to be in almost V-shaped recovery. And the flow of money globally continues to be easy. That these two things put together makes a very good recipe for a sustained run, both in economy and markets. And markets, one should definitely know, that are a volatile animal. So some corrections here and there are never ruled out, but on a medium-term basis, the markets are also in fine fettle.
Right. So, Ambareesh, what's happening in the big indices, which is the Sensex and the Nifty, and what is happening beyond that maybe people are either noticing or not noticing?
No, in fact, till 2020, the last 2 years was basically the large caps which are moving. Mid caps were really getting hammered. But then I would say in the last 6-7 months, it's been a decent play between the large caps and the mid caps. I mean, quite a few of these mid caps have also run up quite well. So it was, I would say it was decently well spread. And part of that could also be because of the number of retail investors who came in. Most of them look at the small and mid caps, and that's what they buy. And that could also be one of the reasons why these stocks have performed.
But and to that point, Ambareesh, do you feel that retail investors are following the herd, so to speak, like they would in any runaway bull market?
Absolutely, because I don't think most of them would be doing too much of a research to find out whether this stock is good or the other stock is good. And the way the tips are flying over the last couple of months, clearly, at least in that space, I see a bubble building up. And normally liquidity leads to a sort of a bubble. The question is, how much more larger can that bubble become? I don't have an idea. It can become larger than what it is today.
Right. So, Amisha, we are at 42,597 and 50,000 used to be a distant target, almost unimaginable. So, which is now looking imaginable. So, that could also mean that people are going to start jumping in or, coming in, we're talking about retail investors, and thus suffer when maybe things turn.
Frankly, we should not forget that when we were in the midst of the COVID and the whole businesses were down and shut, that's the time when also retail started pouring in money. So it is hard to underestimate their savviness, though yes, they don't do very detailed research. But if you also see, the recovery had been in very large caps, because large caps were available at decadal low or whatever. And then, of course, it has been spreading a bit into mid caps. Now with SEBI coming up with this flexi cap schemes, I think that will also give more fillip for this recovery in good names to spread across from large cap to mid cap and small cap also, because there were a lot of constraint in buying small cap or mid caps, which will get reduced. And generally, when the interest rate regime is very low, it is the mid cap and small cap which give disproportionate return, despite the fact that because of disruption, that is digital disruption, the larger the player are becoming more large. I still feel that the better plays within the mid cap, small cap during this regime will give disproportionate return.
Right. So both of you, in a way, have given reasons for why the market could go up further, or there could be, let's say, further liquidity-driven rallies. What could push it down, Amisha? Let me begin with you.
That's a good question. Market needs little reason to push it down. But for example, a very low package in US, the second package which one is expecting, or because the house is slightly divided, some issue over there. The second, we are also going to see some change in regime in terms of policies. Better it is in tax or trading perspective from US. And third is a very strong second wave globally, disrupting the economic outlook again. Some of these things are geopolitical, I think, can disrupt and bring in little more volatility or correction in the markets.
Okay. Ambareesh, what could be the pressure downwards?
Quite difficult to pinpoint exactly what pressure could in fact push it down. For all you know, it could be a butterfly effect. But then one thing I would like to say, effect? Because it could be a small move somewhere which can have possibly a cascading effect across the globe. So you never know as to what it can. What small thing can actually kick off a larger sort of effect. You never know that. So it could start off with a small geopolitical issue. It could be something happening in US. You never know. But one thing what I would like to talk about is the sort of demand which we have seen in the last especially the last 2-3 months. For all you know, it could be the pent-up demand along with the festive season demand, which is really showing a huge sort of numbers now. Unless we really see those numbers continuing beyond December, I would still be a bit skeptical about the sort of demand flow. So I would possibly wait till December to see if the similar sort of a demand thing continues. If that continues, yes, I think you can still say that the economy would get back on track and it is sustainable. But if we again
you're talking about consumer product companies and FMCG.
Absolutely. Yeah.
Okay. And I mean, which brings me to my last question for both of you. And let me start with you, Ambareesh. So what should investors do now, and how can they protect themselves to some extent? And if they want to take bets, what should they be doing?
No, in fact, even now, I think the safe bets would be on the consumer companies and especially the BFSI space, the banks and the financial services. I would still be a bit cautious, a bit skeptical at this point of time. But overall, what I've been telling my clients is that, think of the COVID days and see as to where we are today. If you are making a decent amount of money, book out partially, get into cash to a certain extent, because we really don't know as to whether these good days will actually last beyond the next 1.5, 2 months. And whenever we see a crack, it could possibly be a deep one, because even in the past, say 6-7 months, whenever we have seen a correction, the correction has been decently steep.
Okay, thanks for that, Ambareesh. Amisha, last word. What would you recommend? What is your outlook?
So I feel that this entire COVID hum, the financial sector and our economy seems to have managed well, particularly looking from the credit quality perspective. As we see now, this quarter will be critical to watch, but some of the private banks with very strong subsidiaries into insurance and other businesses could be very well poised, as they are all very well capitalized to harness growth over the next 2, 3, 5 years kind of a scene. So those will be good pockets. Insurance as a sector continues to be under-penetrated in India with very large opportunity. So that continues to be an interesting space, I think. And we can continue to choose a market leader within each of these space. For example, ICICI Bank or HDFC Life Insurance continue to be looking very interesting. And beyond that, I feel economic cyclical, both in terms of, if not direct auto, then auto ancillary also is a very good space. And last but not the least, the third leg or fourth leg of the economy, which should start firing apart from agri-rural, real estate and consumer, is the PLI related schemes and its rollout and growth. So a few within that sector which are into manufacturing also could be interesting play.
So give us a quick example of that.
Who within the manufacturing sector?
Yeah.
So GMM Pfaudler, it's not under PLI scheme as such, I know, but they work behind the pharma chemical boom that we are expecting, and it's underway. So supplying to them and have a client list who's waiting to get supplied from GMM could be a very good play to ride this entire cycle.
Got it. So consumers or consumer companies, including fast-moving consumer goods, banking, particularly the private banks, banking conglomerates who have profitable subsidiaries, and insurance companies in the underpenetrated insurance sector in general. These are the areas to watch out for, and obviously keeping in mind that December is maybe a waypoint where we should be trying to see what happens and whether this the party, so as to speak, continues. We're, of course, just to remind everyone, at our peak in the Indian markets, 42,597 and 12,461. On that note, thank you very much, Amisha Vora and Ambareesh Baliga, for joining me.
Thank you so much.